Welcome to ING's Think Aloud, where we try to make sense of the world in the most unbanky way we can. In today's episode,
despite the fact that deadlines have been missed over and over, we both think that it is responsible at this point in time to go the extra mile.
As things stand, I'm afraid we're still very far apart on some key things, but where there's life, there's hope. But I've got to repeat, the most likely thing now is, of course, that we have to get ready for WTO terms, Australia terms.
With just 2 weeks to go before the Brexit transition period comes to an end, UK Prime Minister Boris Johnson and EU Commission President Ursula von der Leyen say they still haven't agreed on the terms of a future relationship. But there's little sign of panic in financial markets. News that the negotiations will continue past Sunday's deadline, and signs that the mood has become slightly more conciliatory have pushed bond yields and the pound higher this week. But will this optimism last? And what does it mean for the pound if ultimately no deal is agreed? I'm Rebecca Byrne, and today I'm joined by ING's Global Head of Markets, Chris Turner, for his thoughts on this, and to find out what may be in store for other currencies in 2021. So Chris, Boris Johnson has been warning that no deal is still the most likely outcome, but there does seem to have been some progress in the talks, and the market seems to be reflecting that. What are you expecting to happen to the pound in the event of a deal or no deal?
Yeah, certainly we've seen a lot more sensitivity in sterling to events over the last couple of weeks, and obviously sterling falling on signs of a no deal. You see that in other related markets as well. UK gilt yields are moving down as well on signs of a no deal, and I think that's one of the important side issues, is that were there to be a no deal, it would bring back the risk of negative interest rates from the Bank of England, like crossing into negative territory, which I think takes us into a new chapter for sterling. So that, combined with, we think, very little risk premium, surprisingly little risk premium priced into the pound, we think the downside for the pound will be far greater than the upside on a deal. So, for example, euro sterling currently around 90 to 91 pence. So €1 buys you 90 to 91 pence. We think that could rise up to, say, 95 pence. Sterling would weaken, the euro would buy you more were there a no deal, but conceivably that could go all the way to parity in thin December markets. But in the other direction, were we to get a deal, we think it would be a modest rise in sterling, something like 2%, so down to about sort of 88 pence per euro.
Right. I was speaking to our developed markets economist, James Smith, and he was saying that the impact of Brexit is likely to be somewhat clouded by everything that's been going on with the pandemic. Obviously, we have a vaccine now, so that's got to help the outlook for the economy next year, whether we get a deal or not, right? Will that also help the pound?
Yes, it would, as it would help, a lot of currencies that are exposed to the economic cycle. So different currencies have different characteristics, and you'd probably say sterling is traded in line with European currencies, which are generally traded as what we call pro-cyclical currencies. They do well when the global economy is doing well. So I think the sterling would go along with something like the euro if, as it looks like, the vaccines will be rolled out into Q1 and Q2, and the global recovery could really be seen from the second half of next year.
Well, the EU isn't far behind when it comes to rolling out a vaccine, is it? It's also just agreed to push through its recovery fund. So that's presumably good news for the euro in 2021.
Yeah, indeed. I think that's actually slightly underappreciated for the euro, really, particularly the recovery fund. This is going to be funded by jointly issued debt. I mean, a couple of years ago, you'd say this is kind of impossible. Europe is never going to agree to use joint debt. But this has really kind of brought European leaders together, this concept of a kind of fiscal union. And I think that's actually been underappreciated in the euro so far. But as you say, vaccine kind of rollout, global recovery, which we look for, as I say, from the second half of 2021. And I think it's definitely good news for the euro next year. And we can talk about what that means against euro dollar shortly.
But what about the Brexit risk for the euro? We talked about how vulnerable the pound is to a no deal outcome, but the euro isn't immune either, right? What could it mean for the single currency? Because some industries in the EU could be very hard hit by this as well.
Yes, indeed. And people normally talk about the auto sector, which is very much exposed to tariffs and supply chains, a lot of European car production undertaken in the UK. I suppose we would say on a relative basis, And I think there are statistics out there from the IFS, for example, showing that in supply chains, European imports make up about 10% of UK supply chains, whereas vice versa, for EU supply chains, UK imports only make up about 2%. So there is a disproportionate hit for the UK versus Europe. But to answer your point, yes, Europe would be affected adversely by a no-deal Brexit.
Well, let's turn to the US now. We've got a new administration coming in under Joe Biden. The dollar's been in a bear trend, and you think this is going to continue. Why is that, and how much further is it likely to fall?
Yeah, so from its highs this year, probably in about March, when we had a breakdown in US money markets and dollar funding issues really impacted the dollar, and the dollar rallied at the time. Since then, the dollar's fallen pretty much close to 10%, and we see it falling between 5 and 10% next year. And there are two key factors, like a push and a pull factor. So the push factor, pushing money out of the US, out of the dollar, is what the Federal Reserve is doing. They've switched to what's called an average inflation target. So they're trying to really bring inflation back into the US economy by keeping rates a lot lower for a lot longer. And in a way, that's adding to the idea of like devaluing the dollar. Effectively, prices are going up unchecked, and the Fed would welcome that. They feel in the past they've acted too early to suppress inflation and slow growth. So the push is actually what's going on with the Fed and rising inflation and what's called negative interest rates. So inflation is much higher than interest rates in America. And the second factor is the pull, as I say. Now, what's going on in the rest of the world, basically. As the rest of the world gets back on its feet, we can see there are attractive investment opportunities overseas, and that money is being pulled out of the dollar into much better opportunities overseas, particularly in light of Joe Biden winning the election. Trade wars, there's hopes anyway, we don't know for sure, but hopes that we'll see certainly a return to the rules-based order in terms of a return to WTO, more mutual respect for kind of international organizations, and that we think will be healthy for emerging market economies and the world economy in general, and suck money out of the dollar and put that to work overseas, and that should contribute to the dollar bear trend next year.
Which other currencies do you think are likely to underperform in 2021?
Yeah, so if you think about Donald Trump's tenure, so came into office January 2017 and started the trade wars really about March 2018, after he got a big tax cut in place to really drive the US economy and allow him to get aggressive on trade. During that period, so 2018, 2019, and at the height of the trade wars, you'd probably say 2019 was the height of the trade wars, investors were putting money into defensive currency plays, things like the Swiss franc. A lot of money went into Swiss franc deposits. So if we're right about a more benign global environment, we would expect to also see the Swiss franc underperform in 2021. So we think Euro Swiss, which is currently about 107 today, that could rise up to about 115 by the end of 2021.
And what about the outperformers? Which currencies do you like?
Yeah, we feel quite strongly that emerging markets should perform well next year. We've seen a hit to trade from kind of COVID and obviously the pandemic, and we think world trade volumes will pick up, particularly the second half of next year, on a synchronized global recovery, perhaps, the strongest growth since 2017, for example. That's generally good news for emerging markets, and we've actually already seen probably close to $50 billion return to emerging markets since early November, since Joe Biden won the election. So we like emerging market currencies in general. If we were to pick some out, let's say investors allocate the money to emerging markets for investment purposes. Perhaps they're following, some tracker funds. I want to be involved in an EM portfolio that tracks equities or tracks bonds in emerging markets. Well, for example, in emerging market benchmark equity indices, Northern Asian currencies like China, Taiwan and Korea have very large representations in those benchmark indices. And I think those currencies should do well as money flows into those investment products in a way and benefits those currencies. And you've actually already started to see those perform very well just over the last 4 weeks alone. And we think that's a trend that will probably last through the whole of 2021.
Right, Chris Turner, ING's Global Head of Markets. Thanks very much.
Thank you.
This podcast has been prepared by ING solely for information purposes, irrespective of a particular user's means, financial situation, or investment objective. The information does not constitute investment recommendation, and nor is it investment, legal, or tax advice, or an offer or solicitation to purchase or sell any financial instrument. Read more at think.ing.com/content-disclaimer.